Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. Thank you again for attending this week's market update. And the good news is we continue to make some progress here. We're having a decent week so far. And I think one of the big things that's really changed here over the last 2 or 3 weeks, that was a question that we got earlier in the week, is COVID cases have started to come down. And when we move away from the distraction of COVID, when we move away from the distraction of the economic impact of COVID, uh, investors start to open their eyes to some of the valuable merchandise that's on sale in the stock market. And they don't have to just buy FANG, right? Which is Facebook, Apple, Netflix, Google, Tesla, etc. There's other companies out there that are growing their free cash flows, that are paying and increasing their dividends through time, that are positioned in new areas of secular growth, such as energy, the banks, industrials, materials. And we're going to continue to get some noisy headlines here. It's September. Get used to it. That is the month of chop. And we're going to go through all of that today. But so far, what we see is those upside days, we're getting those positive volatility alert days. So names that are going up 5, 6, 7% in a day. Why? Just because money is flowing back into those areas. And then on the down days, we're getting those shallower sell-offs. And that's a reflection of a space that's going through a recovery and a re-acceleration. So definitely something we want to see and something we're encouraged about across the board here. So I'm going to go ahead, as I usually do, and share my screen. And we call the title of the presentation today, Marching Through September. And what we need to really pay attention to is there's a few things here. The market is a little bit overbought. The NASDAQ is really overbought. Now, does that mean everything goes down? No, it doesn't. It means that the stuff that has led to the market being overbought is exposed to a downturn. But underneath the hood of the market, there are very cheap pockets, such as energy, industrials, the banks. Those are areas that are deeply on sale. And those are areas that when the market has come down, they're holding in. And when the market is flat or even up a little bit, they're skyrocketing to the upside, because that's where the value in the market is right now. There's certain names that are trading 40 times. There's other names that are trading 10 times. And those 10 times names, in particular within the energy space, are growing their free cash flow quite a bit. So it's an area of the market that provides bargains, but also secular growth. So the three big takeaways from today's presentation are COVID cases are in sharp decline. We look at those 7-day moving averages, they're going down across the board. As the fear of COVID subsides, investors are starting to turn back to cyclicals. We think this is very early innings in terms of this recovery. We expect a very sharp recovery. Lastly, the global economy is waking up to the great energy shortage. We've seen what's taking place in Europe this week, especially if you follow us on Twitter at LPAM Investments. Follow us on Twitter. We provide those daily market updates in terms of what's going on. But what we're seeing is the entire world is waking up to the natural gas shortfall in Europe, the oil shortfall in the US. Across the world, we have not invested in the energy space. And as a result, we're starting to see those sustained increases in the natural gas and energy market. Now, in terms of the broad market overall, what we've generally seen here in 2021 is the market's been having a series of these 5% controlled pullbacks. These are healthy. We prefer this than those 10, 15, 20% drawdowns. This is a good thing. And we are in this seasonally choppy pattern of September, mid-October. And what do we get? We get just a lot of chop. But the question really comes down to, what do we want to buy underneath the chop? What's the stuff that's already starting to work its way to the upside? Real specifically here this week, we are between the two main Jewish holidays of Rosh Hashanah and Yom Kippur. Those tend to be weak trading days, believe it or not, just because, on Wall Street, volumes go down during those holidays. As those holidays wrap up, we tend to get it somewhat of an inflection back to the upside. And then we have options expiring on tomorrow, on Friday, or when perhaps you're watching this. So the combination between options expiring on Friday and the 2 Jewish holidays, we do tend to get somewhat higher volatility in terms of the day-to-day chop in the market. But fortunately, if you're paying attention to individual stocks, individual sectors, we want to see through that noise and obviously pay attention to stuff that is recovering that was already sold back in June, July, and early August. And when we look at, so we were talking about how the index is overbought, the S&P is overbought, the NASDAQ is overbought. We see it in those rolling 65-day flow of funds, right? So if we look at the S&P 500 index, the index ETF, the SPY, we look at those flow of funds, we're in the 95th percentile to the buy side. We look at the triple Qs, which is the NASDAQ. We're in the 95th percentile to the upside. Extreme overbought conditions in technology stocks, extreme overbought conditions sort of in the index as a whole. Does that mean every stock in the index is overbought? Absolutely not. And we're going to break this down. We know that the index is largely controlled by technology, which is 40%, technology and communications, 40% of the S&P 500. It's no coincidence that the NASDAQ's overbought while the S&P 500 is overbought. So what are the areas specifically that are overbought? What are the areas that are oversold? So that we can move away from those overbought conditions and into the areas of the market that are actually oversold. They've already gone through the correction that the broad index is working its way through right now. So first, technology. We know that higher rates are a headwind for technology. And one of the things that's interesting is through all the economic doubt in the US, COVID, the growth scare over in China, through it all, the 10-year interest rate continues to climb up a wall of worry. After bottoming around 1.12%, we're in 1.33%. Every single time we get a bit of a hit above 1.3 back into the 1.2s, we climb right back up. That's the sign of a resilient market. That's a sign that the bond market is not attracting new buyers in that 1.2 to 1.25 range. People are selling bonds once they get into that level and yields are going up above 1.3%. The other thing we see is the NASDAQ and the ARK funds, right? The ARK funds are very emblematic of what we call high multiple, speculative technology growth. And again, this pattern, when we overlay the ARK funds relative to the NASDAQ back in 2000, continues to follow this pattern to a T. We're not huge fans of overlaying funds because you can manipulate the data, but it really has been following this tick for tick. And it's part of our thesis that we're going to get this rotation away from high speculative technology growth stocks and into the cheaper areas within the market that are poised for secular growth, such as energy, industrials, banks, and materials. So what are those cheap areas? So we look at cyclical sector ETF flows, the exact opposite picture, right? We see this sort of all the way to this 2 standard deviations to the downside, massive outflows. Industrials, same picture, big outflows. Energy, same picture, big outflows. What have we seen this week? Yesterday energy stocks were up 3, 4, 5, 6, 7%. Monday, same sort of action. On the down days, maybe down 1. That's the type of action you want to see when bottoms are starting to be put into place. It's no surprise because that comes right as these COVID 7-day average case count is diving to the downside, right? Remember, we said August 15th was going to be that peak. I think we pretty much got that spot on. We were off by a couple of days, but we're starting to see those cases dive, and that was part of our framework. Within the energy market, the US is the best positioned country on the planet to be the global supplier of cheap natural gas. Right now, natural gas prices in the US are $5. What are they in Europe? $24. So even when you account for liquefaction of natural gas in Louisiana, the cost of shipping, the cost of regasifying that gas once it gets to Rotterdam in the Netherlands, once all those costs are taken into place, there is a huge arbitrage trade for natural gas suppliers in the US to take domestic gas and ship it overseas and make a whole lot more money. And that's part of the reason why you've seen gas prices in the US go up, because we're at $5 while Europe's at $24. Europe wants our gas. We are an energy powerhouse. It's time that we embrace that. We can see that US exports of natural gas are skyrocketing through the roof. And don't listen to the rhetoric. Natural gas is a clean form of energy. Yes, it does have a carbon footprint, but much, much, much less than what that coal has, thermal coal here in the US and across the world. And Europe needs our gas now. These are power prices in Europe. Absolutely skyrocketing. It's becoming a huge political issue in Europe. Fortunately, our investors have exposure to gas. They are benefiting. One of the reasons why you've seen the strategies move up so much this week. Why? Because we have what Europe needs. We have what Japan needs. We have what China needs. We have cheap, low-cost natural gas. And oil demand continues to march higher. We are now, when we look at oil demand, we're now above 2019 levels. We're above pre-pandemic levels. Meanwhile, the amount of investment into the energy space has collapsed. The amount of rigs in the US at $72 a barrel today is approximately 60 to 70% less than the amount of rigs the last time the US saw $72 crude oil prices back in 2018 and 2019. That tells you something. That tells you that as the space has changed its compensation structure to reward return on invested capital versus production growth, that energy companies have become more disciplined. That's limiting the supply response in the US. We're not taking uneconomic barrels out of the ground. The barrels that are coming out of the ground are profitable barrels, feeding free cash flow, leading to dividend increases. This is the new income space. Energy is the new space for dividend income. And the stocks are dirt cheap. That is why we're invested in the space. So when we think of the ingredients of that bull market, 10 to 15 years of demand growth, even if we assume 90% conversion to electric cars. Why? Because of the huge growth in the plastics market. Petrochemicals, #1 source of crude oil demand. Global capex in the energy space is collapsing. The supply response is not there. We got declining global offshore production, and peak shale supply has already hit. All that combined with OPEC's spare capacity being spent by next year leads us to believe, based on our research, that we're in the early stages of a multi-year secular bull market in the oil market and the natural gas market. So overall, as cases are starting to decline, that is allowing the market to appreciate the value of a lot of these more economically sensitive stocks. Now, the fortunate part is some of these economically sensitive stocks, such as energy, industrials, financials, are also in the early stages of what we consider a secular growth market. As we power infrastructure, energy shortfalls, we've got to meet that demand. All these things are feeding into a new secular growth cycle that's away from technology. First, stock market is overbought, but its cyclical component is oversold. And that's where we are positioned right now. US enjoys a global cost advantage in natural gas. Let's take advantage of it. And then lastly, demand is set to grow by 20 million barrels despite electric cars. So again, if anyone has any questions as we're going through this rebound, and if they have any concerns, please feel free to reach out to your advisor. Feel free to reach out to us at 888-543-3776. And please follow us on our Twitter account at LPAM Investments. Thank you again and have an absolutely fantastic weekend. And thank you for all of your business and trust.